Hello investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. Well, our forecast turned out 100% right across the board in every market, and as I do each and every week, I leave my lines in place so you can see what I drew last week and how the forecast panned out. This is a one-year daily candle chart of the diamonds, which is the Dow Jones Industrial Average ETF. And as I zoom in, you can see that I said we would most likely test resistance and then pull back from resistance, with the end of this line being my target. We actually hit that target on every single day, Monday, Tuesday, and Wednesday, and then surpassed the target on Thursday and Friday. What's happening right now is an interesting turning point as we approach this horizontal line, which is known as a flatline support level, right around the 250 area. And the stochastics right down here, the %K, which is the blue line, is showing oversold. My guess is that that will start turning up next week, eventually leading us to a buy signal. And that buy signal will occur when the blue line, the K line, crosses the red D line. As far as the CCI, which is the Commodity Channel Index, it is now reaching an oversold condition. That too, I believe, will start turning up. But the key signal that I'm paying most attention to is this long green candle at the end of a long stretch of red candles known as a stale red light. That green candle tells us that the buyers are starting to move in, and I believe they will for next week. So let me erase this line, which is my forecast for last week, and this line right here, just clean up a little bit. The chart needs to be clean and clear so that we can get a crisp signal. And as I mentioned a few weeks ago, we are stuck in a trading channel here with this resistance high and this horizontal line being support, as I just mentioned. So I think we're going to start turning up next week, going right back towards this 20-period moving average, which is the blue line. So that's my forecast for the diamonds. If you look at the spiders, that's the ticker symbol for the S&P 500. My forecast lines are in place again. I said we would go up. I have to zoom in a little bit more because it's hard to see through the red. I said we would pull back from resistance. We had a bearish engulfing pattern here. We moved right back down to the 20-period moving average, hit my target, surpassed that, came very close to filling this gap, which is now going to act as a support level right there. So let me redraw that support level for you. That gap fill point will act as support. Most of the time when a gap fills, we see an 80% chance that the stock reverses from that point and goes higher. I don't think the market's going to drop much lower this week coming up. I think we're going to just go straight back up to that 20-period moving average and stay in this general vicinity right there. Now, the S&P is really inversely to the volatility index, and I could say that the other way. The volatility index is inversely related to the S&P. My forecast was that the CCI would start to turn up, creating a buy signal for the VIX. That happened right there, right where my cursor is. So that panned out perfectly. As a result, we did bounce off of support right here. And as I zoom in, you'll see that we moved right up to my target, which is the end of that line. But now, look at what's happening. We have a bearish engulfing pattern right there on the volatility index. That means there's an 80% chance that the volatility index is going to start to drop from this point. So I think we're going to go right back down to test that support level down here. And in the meantime, the lower volatility index will most likely create buying pressure on the S&P 500. Once the volatility index gets down to support and starts turning up, then we have to watch out for the downside in the general markets. Again, they're inversely related. Now, if I look at a more broad-based index in the Russell 2000, that's ticker symbol RUT. You can see again my forecast worked out perfectly. I said we would pull back from resistance and move lower. We did that. We hit the target, went beyond the target, and this support level is holding quite nicely. I'm going to erase these fan lines because these worked out perfectly as well. Once a fan line is broken, it generally goes to the next fan line. It did exactly that. I'll tell you, folks, the technical signals are working out like clockwork. For a little while, we were out of sync, but we're right back in sync now, and these signals are working exactly like we expect them to. This is a more or less a hammer slash doji right there. That's usually a sign of a pivot point forming. I think we are going to start moving right back up in the Russell 2000 just like that. The evidence that supports the idea of higher prices in the Russell is that the stochastics right here is starting to turn up from an oversold condition. Once the K crosses the D, that creates a buy signal, which brings in more buying pressure, and the CCI is now oversold. I expect that the CCI will also start to move up. So keep your eye on the upside for the Russell 2000. I'll erase these lines again to clean up the chart. And as you can see, what's left is we have two parallel lines right there, which are known as a trading channel. Support and resistance running parallel with price oscillating in the middle is a heaven for swing traders, day traders, and option traders. It's a little frustrating for investors because investors are more long-term in their mindset, but traders are having a field day in this particular market. Finally, the Qs. That's the Nasdaq market represented in the power shares right here. I said we would go lower, pull back from resistance. We did just that, ended right at my target this week, and now we have a green candle on slightly higher volume, leading us to believe that the buyers will come back in the Qs as well. So that's our forecast. I hope you enjoy it. If you'd like to learn more about what we do at the Market Guys, just go to themarketguys.com. I have one spot left in my mentoring class. If you're interested in that, just send me a contact link right there. Just click on contact, send me a message that you're interested. I'll give you a personal call, go over that. Have to first find out if you're even qualified. The minimum requirement is you need at least $100,000 in your trading account to make it worth your time. We have our students are making really good money. I'm not going to mention any names until I get their permission, but one of our students with one trade made just under $10,000 on a stock that we put out in DRIP. That's DRIP. That is the bear fund for the oil market, and he did really well with that one. So if you're, again, interested in mentoring, you want to learn how to make money in this type of market, just reach out to me and we'll reserve a spot for you. So enjoy the rest of the weekend, and we'll talk to you soon. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.